We've seen U.S. stocks struggling a little today. Our guest says there's less optimism about the Federal Reserve continuing with these interest rate cuts, at least in the near term. Let's get more from Karl Schamotta, Chief Market Strategist at Corpay. Karl, thanks very much indeed for joining us. What's jumping out for you in the markets today?
Yeah, I mean, we're still seeing this hawkish repricing of Fed expectations across the curve, but particularly around the December meeting. This is on the basis of Susan Collins' comments yesterday that she was waiting essentially to see what might happen in labor markets, that she's still aware of inflation risk running a little bit too high, and that she wants to take a cautious approach to cutting rates in the coming months. And I think the key thing there is that Susan is typically considered a centrist on the rate setting committee. She's not someone who, has traditionally expressed dovish views, at least in public. And so, this really tells you that there's a split on the committee, and that the contingent of those who, want to do a pause in December, who want to wait for more data to come out to get a clearer view on what's actually happening in the economy, that contingent is growing. And so, this is forcing up U.S. yields a little bit, and helping to tighten rate differentials across the currency markets.
What about the lack of information in the market of economic data, such as crucial job figures? It's not just a worry for econometrics nerds?
That's right. Definitely, there's another breed of nerd that definitely does need to worry about this, and it is the monetary policymakers who are, relying on this information in order to assess the state of the economy and to make decisions. But I should also say, well, first I should say, I guess, that we are going to begin seeing data coming out in the coming weeks. That is going to help markets to recalibrate expectations for the December and early year meetings for the Fed. That'll help to some extent. But I also think that, Fed officials themselves are much like private sector economists in the sense that they're generally not too focused on, any one given data point. They tend to look at a wide variety of factors before they come to a decision. And so, right now they're looking at a lot of the private sector measures. They're looking at, the upcoming Beige Book survey. They're looking at, a huge range of factors that can help them to determine what's happening. And so far, those indicators are telling us that there is a mild slowdown happening in labor markets, and that inflation pressures remain relatively tame. And so, this to me suggests that the odds are still slightly in favor of a cut in December, even if, the possibility of waiting till the early new year is also very strong.
Can we switch to AI? Maybe we'll put up a 5-year or 10-year chart for the NASDAQ composite as a proxy for tech stocks. Wall Street Journal has a headline. I mentioned it just a moment ago. Big tech soaring profits have an ugly underside. OpenAI's losses. And the journal arguing that AI startups such as OpenAI and Anthropic are just sinkholes for losses. And that can only continue for so long, presumably.
You would think, the reality is these things tend to go on for a lot longer than anyone might expect. And I think as much as we're having this sort of AI ebullience, there's also other factors in the macro economy that are sustaining what's happening to asset prices, right? The fact that the Fed is thinking about easing is a major factor. The fact that the U.S. economy is slowing but not crashing is a major factor. Financial conditions remain incredibly abundant. And so, there is this liquidity backdrop that's translating into upward pressure on assets. And so what that does mean to me, and clearly it means the same thing to the Wall Street Journal, is that, the party's going to go on until the liquidity taps get turned off. And so, this sort of circular lending and investment model that is dominating the AI sector does look very vulnerable in the event that we ever do see a large and significant withdrawal of liquidity. And that could mean that we see a big knock to asset prices at some point. And I'll say, I'm sure you're seeing very much the same thing, but virtually every time I talk to a market participant anywhere in recent months, the reality is that they're all looking for the exits. They're in their positions, but they're signing prenuptials with those positions, right? They're looking for what are they going to do if this goes wrong, and so this is probably not the typical bubble in that sense. It does seem very well broadcast this time, so. What we do need to worry about is that reaction function. It is, what happens if something spooks the herd and everyone moves out of the tech stocks and into more defensive sectors and safe havens.
We just got that federal budget. We're talking about a deficit for 2025, 2026 of almost $80 billion. Karl, first off, the take of many people on this budget seemed to be that it was a bit wishy-washy. There weren't big spending cuts, and there weren't decisive moves to stimulate the economy. Some people, for example, wanted a cut in the corporate tax rate.
That's right. It definitely did land in markets with sort of a soft thud. We did not see, any dramatic moves in the currency. And in fact, I looked at the Canadian dollar in the hour after the budget dropped, and I think it literally moved 10 pips in that time, which is, that's less than it normally moves in an hour. And so, the reality here is that markets did go into this having relatively high hopes, I think, and some fear, some trepidation around the scale of potential borrowing. Instead, this looked like a very cautious set of initiatives and not the comprehensive top-down tax reform that Canada really does need. And so perhaps, the Liberals are hoping to have a stronger political base in the years ahead from which to do things like that. But at this point in time, it's not enough to move the needle all that dramatically for the Canadian economy.
Quite a few corporate leaders apparently think that if we are going to raise taxes to try to rein in the deficit, a higher sales tax is the way to go. And I think a lot of economists say sales taxes are generally efficient because they don't discourage investment.
That's right. I think, if an economist was to come up with a dream tax, it would look like a sales tax, given that, it is regressive. It tends to, impact people in the highest earning categories and the highest consumption categories more directly, particularly if it's well targeted. And it does act as an incentive to the right kinds of activity. And on the flip side of that, we do want a tax structure that incentivizes investment. That does contribute, and we have seen moves toward this, but does contribute to that rapid depreciation of new investment in plant and equipment in Canada. And so I think corporate leaders are thinking along the right lines here. But also, I would say that, when we look at that overall fiscal position, although there's been lots of sort of alarmist headlines out there about it, Canada's debt problem is not on government balance sheets. It's very much in the household and corporate sectors, right? After the 90s and at the end of the end of the 90s, we did see a very concerted measure or set of efforts to bring down that debt. And so now Canada is in a relatively good position. There, unfortunately, households and corporates have picked up the baton, and we have debt to worry about there. So, I don't so much worry that the government will need to raise taxes in order to offset its spending in the near term. I do worry that we're going to continue to see weak investment and weak consumer demand in Canada.
What about the fear that if you include the province's debts, we really do have a bigger government debt problem than we think. And also, if we factor out the massive assets in CPP and Quebec pension plan, of course, they are counted against the debt, but the government really can't dip into that, can it? We need it for our pensions.
Yeah, so there's a lot of argument around the shell games that get played, right? And so the numbers that were used in the budget do understate the amount of debt that Canada is holding as a relative share of GDP. The reason for that, as you alluded to there, is that some of the debt is subnational and we have all of these other offsets. However, the measures that currency traders tend to look at and international economists take all general government debt, they put it into one pool, they look at the offsets to that, and they calculate it on that basis. And on that basis, Canada is second lowest in the G7 when we think about government debt to GDP. It's just next to Germany, right? And so, it's not as if the shell games that are played by within our national structure actually detract from that overall picture, right? And I do think there's considerable confusion about this out there, and a lot of misinformation. And so, it is common for market participants to think that Canada has a bigger fiscal debt problem than it does.
I think we've touched on this before, Karl. Obviously, improving a nation's productivity is a long and complex process. Do you think there really is the potential for us to reduce red tape? I mean, every society on earth is burdened with more and more bureaucracy. Bureaucracy tends to metastasize. Every official sees a reason for putting on more regulations. Will we really streamline things for businesses in this country?
I sure hope so. I'm actually thinking of doing a presentation series next year on that's going to be titled "Overruled," just because there's so much of there's an impetus to adding more and more regulation that just seems to be a part of the structure in English-speaking countries, right? It is just steadily increasing over time. It is very, very difficult to roll back. It takes everybody to sit around one table and to have their incentives aligned in order to actually roll that back. And unfortunately, in Canada, due to the decentralized nature of our governance structure, in other words, municipalities have a lot of power in Canada, provinces have a lot of power, and the federal government essentially only has tax and spend capabilities. It does not look as if we're going to make a meaningful dent in the level of regulation anytime soon. I do think that the push is there. I do think that that our hearts are in the right place, but the structural incentives aren't there. And then secondly, I would also point out that, in Canada, the amusing thing is that you hear from businesses from coast to coast who complain about regulatory red tape. But when it comes time to regulate their own industry, they're very much in favor of putting on rules that protect them, right? And so, this is essentially the nature of the problem, is that all sorts of participants in the economy have an incentive to put in rules that do protect them, but fail to recognize the broader consequences. And the reality here is that across no Western country at this time are we seeing a conclusive turn in this. The only countries that we can point to that seem to be successful are countries like Singapore, which to say it politely, are not necessarily democratic in terms of how they're implementing these things. And so I'm not sure what the path forward is, but we definitely can't bet on a 90-degree change just because we've had this external shock from Donald Trump.
Karl, thank you very much indeed. Really appreciate it. Karl Schamotta, Chief Market Strategist at Corpay.